We've still got some seats at the front for anyone brave that's standing at the back.
Yeah, we won't do that.
Okay, I'm going to make a start. So first of all, very warm welcome to everybody that's in the room and that's online. Just a few housekeeping points. This is being recorded, this session, and we will be taking photographs throughout, so just to let you know. We are not expecting a fire alarm. So if there is a fire alarm and you're in the room, please take the staircase, which is just behind the lift, just there, and we will meet in the park opposite and make sure that everyone is present and correct. And final point, please, can you put your mobiles on silent? Thank you very much. Well, we have a fabulous session planned today. It's our second session in the Climate Just Transition event, and we're really looking forward to having an interesting conversation, nurturing a dialogue. We have an interesting collection of people in the room and online, and we're really hoping that we can share ideas, build relationships, because we are absolutely passionate at Chemonics about climate and putting climate at the centre of everything that we do. And we really do think that it's through private sector engagement and impact investment that we're going to meet the existential challenges that we are facing. So I'm Louise Quay, I'm the Managing Director of Chemonics UK. Chemonics is an organisation which is absolutely passionate about local solutions to local problems. We have 6,000 staff in over 100 countries. 90% of those staff live in the countries that they call home, and we find that they tend to come up with the best solution to the problems that they know so well. So it is this approach to localization that has meant that we've used our own capital to invest in solutions. In Africa, we invested in Invest Africa, which is one of the leading African-based investment houses. We've recently invested in Tolino, which is a social finance solution that enables social engagement across Africa to those who have been disenfranchised. So that's a little bit about our commitment. There are people on this panel who are deep specialists who can talk to you about trends that they are seeing across impact investment. So Kieran is joining me and also co-chairing today. Kieran is the CEO of Impact Investment. This is the second event that we've run together, and it's great having you all here. Sophia Omar is a manager at Impact Investment. Thank you for joining us. Amar is joining us. He leads an organisation that is very much focused on access to energy across Africa, which is going to be so critical. And our very own Tara, who is a senior advisor for the CFDA programme, focusing on investor relations, and is also our director of private sector engagement and climate. So a warm welcome to you and a warm welcome to today's panel. We're going to start off with a panel discussion, followed by a Q&A, and we're really going to focus on those people who are online asking questions. So please use the chat facility for that Q&A. After that, we are going to say goodbye to those people who are online, and we're going to have some breakout sessions in the room where we really do want you to come up with ideas and ask questions to the specialists that we have today. Kieran.
Brilliant, thank you, Louise. And it's wonderful to be here today. We've got so many people joining us online, but thank you to those people who joined us in person as well to brave Storm Kieran to get here. Got a bit worried when I heard about that because I thought they were naming storms after climate deniers now, and I'm certainly not one of those, and that won't be the theme of today's discussion. My name's Kieran. I run the Impact Investing Institute. Great to be here with so many friends, colleagues and fellow travellers. At the Impact Investing Institute, we're about accelerating the speed, the pace, the scale of capital that is being deployed to the world's greatest challenges. And that's really what we're going to be discussing today. At the Institute, we've been working on the concept of a just transition for several years now, and we've seen it become a familiar concept not only among catalytic capital providers, but also among mainstream investors. And there's a lot of potential and opportunity within that. We're happy to be with so many people to celebrate the launch of our new guide on using catalytic capital for a just transition globally. And that's been generously supported by the Catalytic Capital Consortium, and which you can find on the Institute's website, and I'm sure we'll make sure to get the details to all of you. We often think of a just transition as having three elements, or three legs of a stool, if you may. So there's the climate and environmental action, there's socio-economic distribution, and community voice. And the idea being that these are all integral, these all need to be aligned to be successful in achieving a just transition. Now, the idea of green and social being two sides of the same coin is being recognised by many development funders. So to give just one example, the World Bank has updated its mission. Its mission is now extending extreme poverty and boosting prosperity on a livable planet. And it's that last bit which is the new addition. But on the other side, with mainstream investors, we're seeing more and more of them looking to integrate social considerations into their green investments. We run something called the Just Transition Finance Challenge. It's a community of practice for asset managers and asset owners who want to do this in their investments. This community of practice now has over 24 partners managing over 4 trillion of assets under management. So we're talking about some serious engagement here. But it goes further than that. So it's not just about the alignment of social and environmental, but the imperative for a just transition derives from the need for global climate justice. And in the run-up to COP28, there have been more and more calls and initiatives to support a transition to a net zero that supports and doesn't hinder local development priorities for countries in the global south. And we need much more private capital to flow to the places where it's most needed for the transition to succeed. So that's what we're discussing today. These are big, big questions, but we've got an excellent panel who are incredibly well placed to help us explore them. And as you'll discover, they're each working on very practical solutions about how we get into these ingredients for a just transition. So we're going to be discussing the importance of the transition being just, the need to mobilise more private capital to bridge the climate and SDGs gap, which is a large gap in the trillions, and ensuring that the transition finance activities reflect local needs and context. So as Louise mentioned, we're going to get insights from the panelists in a short discussion. We've given them an extraordinary short amount of time to share a lot of detail, so we'll beg your forgiveness. And then we're going to turn to our online audience for questions. And then those in the room today, you're going to have the opportunity to join breakout groups afterwards, which will be led by each of our panelists, and you'll be able to explore more detail of the areas that they're going to be covering now. So I hope that works well for everyone. So this is where I turn to the panel, and I'm going to turn first to my colleague Sophia for the Impact Investing Institute. So Sophia, in this report launched today and more generally, you've been exploring barriers and opportunities to the deployment of more catalytic capital for the just transition, with a particular focus on emerging and frontier markets. Can you talk us through some of the findings of the report and some of real-world examples of the vehicles and investments that you found within it?
So as a starting point, not just online, but a fun QR code on all of your seats. Shameless plug, my apologies. I mean, it's been a fascinating journey, and we've spoken to such a wide range of actors in this report. And I think what's really key is really starting with what you're trying to do. The just transition is a very big concept. And there are huge challenges and barriers to getting to that point. They are not insurmountable, but they are a series of interlocking problems rather than just a just transition to net zero. And in some contexts, that might be access to capital. In some contexts, that might be a sense of this country is too high risk. In some sectors, it might be there is not enough deal pipeline suitable for capital flows. And I think one of the things we've really tried to surface in this report is a series of examples across asset classes, across geographies, and crucially across different types of catalytic mechanisms. So you have on one end of the scale, the African Climate Foundation's Energy Access and Just Transition Program, which really looks to understand what are the needs at a national level for a just transition, what are the needs at a regional level, and bring those understandings of local needs to global conversations, including supporting in capacity building at an international level through negotiations in order to facilitate a just transition. At the other end of the scale, you have an example like Inspired Evolution, a South African-based fund, Evolution 2 Fund, and they have offices across the African continent. And they have, much like my colleague at Kawasaki, a focus on access to energy. And one of their projects in Evolution 2 is an investment in a solar panel plant in Burundi. It's the largest investment in Burundi's electricity grid in 30 years. That's solving a problem. So I think it's about thinking about what are those interlocking problems, where are the kind of targeted interventions at a local and at a global level, and how can those come together and
Brilliant.
change the system.
Thank you. So if we just drill down into that, and people were to come to you for your top 2 or 3 suggestions in the opportunities for catalytic capital providers to mobilise more private capital at the scale required, what would you suggest? What would you point people towards?
So one, and I think this is a big focus of the report.
Sophia, you have to be slightly louder.
Of course.
When you turn one.
I'm so sorry. I shall look out
Yeah.
to my audience. My apologies. I was talking too much to you here. Firstly, and this is a big focus of the report, is the importance of localization. You know, Louise, you touched on this in your remarks. What we mean when we know what the transition to net zero looks like. What does just mean? That looks very different in different contexts. And if you are not speaking to, working with affected communities, it is likely not going to be just in every context. So that's really key. And there are a whole host of very interesting mechanisms by which one can do that. So one of my favorite examples in the report is the Blue Orchard Insure Resilience Fund. So the ultimate aim of the fund is microinsurance for communities affected by climate change. It is a global fund. It has attracted huge institutional capital. It uses a blended mechanism, but it also has this technical assistance facility that allows for deep engagement with affected communities. And that not only deepens the impact, but it also means that the product is used and contributes to the success of the fund.
Yeah. And if in fact, very quick show of hands, who would self-represent as being from a catalytic capital provider in the audience? You? Who would see themselves as being from an investor of some form? People. Okay, so we've got both in the room, and I'm really intrigued about other people as well. So we've got both catalytic capital providers and investors in the room. Can you give examples of, with active investments or kind of active provision of catalytic capital, how people have been aligning? So this kind of this concept that is just transitioned about aligning the climate element, the socioeconomic and equity element of the community.
I'm going to give another shameless plug, if I may. Kieran's already mentioned our Just Transition Finance Challenge. One of the things that sits under the Just Transition Finance Challenge is something called the Just Transition Criteria, which is really a set of criteria and metrics that one can use both retroactively on a fund, but also in developing funds and instruments to align with these 3 just transition criteria that Kieran spoke through. So climate action, socioeconomic equity, and again, community voice, which I think is such a key part of the stool that's often lost or thought of as secondary in some capacity. So as a very first piece, join the Just Transition Finance Challenge and look at the criteria. But there are some really exciting examples in the report of how, so again, I think all of the examples in the report are my favourite, so apologies. The Private Infrastructure Development Group through InfraCo, one of their investment arms, has invested in a ferry system across Lake Victoria. Now, when we talk about the just transition, the energy transition is the obvious thing that we will go to, and we talk a lot about renewable energy, and that is obviously crucial. What's really interesting about this piece is ferries across the. So firstly, they've invested in the system. It is a lot less carbon intensive. They are trying to green the ferries. They are contributing to the local economy through facilitating the movement of goods and people across Lake Victoria. It's also hugely contributing to the safety because hundreds of people die every year crossing in unsafe boats. It's this wonderful coming together of all of these elements, and my understanding, and check case study, was very much that need was articulated, the understanding of why that investment and that investment opportunity was very much through them being very active in those areas.
Brilliant. Thank you, Sophia. We're going to move to Tara. Tara now. Tara, as we spoke before this event, we spoke about USAID's Climate Finance for Development Accelerator and how this is a great example of a new facility seeking to use catalytic capital in support of a just transition. So for those in the audience who are less familiar with the accelerator, could you just give a little bit of background on how the platform works and how within it you've articulated this idea of climate and social development?
Sure, and my examples very much echo some of the things that Sophia has pointed to, and I will start off with some background and context. So for background, in 2020, according to BlackRock, the global climate investment in emerging markets outside of China was about 200 billion. And according to IEA, the required climate investment in these same markets would actually exceed $1 billion annually up to 2030 to be on track for net zero. At the same time, as many of you know, and I'm sure III knows and working with many asset owners, there are obvious headwinds that limit institutional capital flows to climate at the scale needed in these markets. Many institutional investors note that emerging and frontier markets have underperformed relative to developed markets over the past 20 years and relative to some of their expectations. There's actual risks, such as political risk, and perceived risk, both of which are amplified by information asymmetries and data gaps, which is blocking the flow of climate finance to these markets. This is even more amplified when you consider a just transition. So just adding to some of your examples, we know that women investors tend to consider social and environmental factors more than their male counterparts. Some studies suggest they're twice as likely to consider these factors. But we also know women are underrepresented in leadership of asset management. Yet, many institutional investors will look for track record, and they'll have other DD criteria that continues to limit the representation of women-led GPs capturing institutional capital at scale. Someone needs to take a punt so that these women-led GPs can be deploying more climate finance. We know that when it comes to the rural areas where there's the most flora and fauna, that these areas are really critical to a net zero transition, and yet capital is not flowing. There's really high transaction cost for reaching them, and some of the financial innovations that we're seeing, like debt for nature swaps, someone once again has to take a punt to make these things more bankable, more scalable. So these are just vignettes, but my point is there's still so much de-risking to be done so that this institutional capital can flow in, which is why we are so pleased that USAID has set up the Climate Finance for Development Accelerator, also known as CFDA, lovingly known as CFDA, which is managed by Chemonics. CFDA is a $250 million initiative that's aiming to mobilize $2.5 billion in public and private climate investments by 2030, and is making good progress, by the way, but we'll get into that in the breakout. CFDA works to develop and scale effective partnerships and innovative investment solutions, like some of the ideas I started to touch on earlier. And so it can strategically bring catalytic capital to funds, enterprises, projects, defraying cost, offsetting risk, thus opening the pathway for more institutional and other commercial investors to then enter the fold. And the way that it works is that USAID through CFDA identifies climate finance challenges, which can be at the country or regional, even thematic level, and designs projects or vehicles or facilities to address them. These can range from a variety of mechanisms, which we can get into in the breakout, whether it's catalyzing the blue economy, clean energy in Pakistan, or resilient infrastructure in the Caribbean. CFDA can provide a range of solutions for crowding in capital, designing and managing funding windows, which identify, evaluate, and then award catalytic capital, primarily to fund managers and financial institutions, as well as ventures that are directly building technology or other climate solutions. And we can get more into that in a bit.
Brilliant. Tara's doing that thing that I was worried what was going to happen is that the panel know that there are breakouts coming and they're starting to kind of get their pitches in for you to go to theirs. No. Well, let's use the opportunity now, particularly whilst we have the online audience. Can you give some practical examples of with the instruments? I guess what we are asking for here is at times for investors to invest in geographies, in sectors that are less familiar to them. So there's both risk, but there's also a lack of knowledge or uncertainty. So what instruments and vehicles are you finding, or do you have hope for in being successful in that regard?
I can talk through some of the ones that have already been awarded, and the rest I'm saving for the breakout. Our public and private sector partners, we've done about 11 different vehicles to date, which have already mobilized over 300 million. And they are very much intended to be market driven. So what is needed for that country or region, sector, ecosystem? Some of my favorites, and actually they quite relate to what we were just talking about, are the Climate Gender Equity Fund. Shameless plug for our friends at 2X Global, which is, the global gender lens industry body. They are managing that fund, and that's addressing precisely what I referred to earlier, which is the lack of women-led funds, the lack of women-led ventures in the climate space and emerging markets. So that actually is live, and they're looking at fund managers to award grant capital now. We're doing that in partnership. CDFDA is doing that in partnership with Amazon, USAID, and Reckitt, and more foundations coming in. This one has been a grant mechanism. For another one, the Green Guarantee Company, we don't have enough green bonds in emerging and frontier markets, and how hard it is to set them up. The Green Guarantee Company provides guarantees to green bonds, and I won't get into the instrument now because that's all still being delineated in collaboration with USAID. But the point is we're helping the Green Guarantee Fund to reach their first close of 100 million.
Thank you. That's really helpful, Tara, for giving more detail. And you can go to the breakout session later. I'm going to move on, if I may, to Amar and bringing a real practitioner's perspective. So you're a fund manager based in and focused on emerging and frontier markets. And so you've been listening to this conversation. I wonder what perspectives does being based in and focused on emerging and frontier markets bring to this discussion?
No, I appreciate that, and great comments coming from this panel all the way around. I think it's so easy to generalize and so hard not to. We're based out of Nairobi, so that's the perspective I bring to this. We're based out of East Africa. We invest in equity, and we invest in companies that are really driving towards big social environmental goals. So think of the SDGs, think of some of the companies that might deliver toward the SDGs. Those are the sorts of companies that we'll invest in. Generally, they're small to medium-sized companies, so all of the challenges that small to medium-sized companies have, but then multiply by a factor for the issues that we're really trying to face. But where we sit is we're primarily investing in low carbon opportunities to reach SDG 7. Right? So residential, commercial, solar generation, distribution, the financing systems that sit behind that make these things more affordable. So one of the things we look for is how to make, or where are the companies that are helping consumers to access products by introducing this idea of radical affordability. We don't want to just be thinking about Teslas to the richest 0.5% to sub-Saharan Africa. We want to be thinking about two-wheelers and how e-mobility and micro-mobility will really empower urban transportation and get people and products from place to place much more quickly, much more reliably, and much more cheaply, because those are the sorts of things that people really need. So that's the sort of framing for the kind of work that we do. in terms of what we see and reflect on these conversations, I think what we're hearing is great. There's this sort of increasing swell of support of innovation, of catalytic capital, of folks kind of thinking about what are some of the constraints in our markets and how do we overcome some of those constraints. And the reality is that still it's too hard and it's taking too long. There's an increasing level over the last couple of years of real frustration in our markets, not just from the consumer who says, where are the electrons that I need to keep my house warm or keep the lights on for folks to do their homework, but from the companies that are driving those electrons and creating the products, the energy efficient refrigeration, the e-mobility scooters. The capital starvation is real and it's hard. It's really hard at this particular moment in time. So just to give a sense of it, cost of capital, I think, is the biggest issue that we all face. Cost of capital in Europe and the US has gone up 6 points. That's hard, but how many businesses in Europe and the US will survive and be profitable when they're paying 18-19% on dollar debt? You can't be profitable at those rates. And so we have expectations as investors for profitability. The reality is we're setting ourselves up where the consumer with the least purchasing power has to pay the most to cover the cost of capital to allow for a wind farm or a solar farm to be profitable. It's crazy. So that we're in a very difficult set of situations. To characterize it, I think what we heard at the Africa Climate Summit and then kind of pulled together at the end of the Africa Climate Summit over the summer was this extraordinary opportunity of emerging markets, risk, yes, etc., but extraordinary opportunity in emerging markets. Fast-growing populations, well-educated, well-connected, increasingly urbanized, increasingly connected through technology. But a real resistance from capital providers to see those markets as whole and real, a poor track record that doesn't support the narrative of we need climate capital now, and a real gap as a result between the trillions we talk about at GFANZ, etc., and what's actually available for people to do on the ground. So the sort of plea from all of us is think about what companies need on the ground, think about what consumers need. How do we drive real affordability to allow low carbon solutions to meet the ubiquity that we all need? But if emerging markets continue on their trajectory, we need to quadruple energy consumption in emerging markets. Ethiopia needs to 100x electricity consumption to come anywhere near the US, 100 times. If that continues to come from fossil resources, then we failed as a society, as a planet, we failed. So what are the solutions that can provide those electrons, that can provide the consumption, that can provide for improved economic inclusion, jobs, livelihoods, and growth? How do we get capital to them? We sit alongside folks like Inspired Evolution and others as a capital provider in market, trying to look at deal flow. We have 400 individual transactions that we would track at any one moment in time. They're all private transactions. They're not particularly publicly available. And we often hear it's too hard. Those transactions are too small. The returns are not going to be good enough. So at what point do we stand up and challenge the markets a little bit to say we have some real talent on the continent that understands how to arbitrage those risks, understands how to bring some of the really potentially investable prospects to the market, and how do we get those into the flow? But big challenge.
Yeah,
big challenge.
Very quickly, if I may, what we've been describing here is also about the alignment of social and environmental and community perspective. Very, very practically, how do you articulate those social and environmental aspects within your fund structure and ultimately your investment decisions?
Very simply, so we invest in the firms that have KPIs that will either mitigate CO2 emissions or will fundamentally drive a narrative around adaptation and resilience. So if our companies are not doing that, if their products and services are not doing that, we won't invest in them. And we have a theory of change and a set of KPIs at the fund level that we get held accountable to as a fund manager. So we don't get our carry and we don't get our bonuses unless those KPIs get met, right? So we have an IRR and an impact hurdle that get kind of tied together. I think the second thing we've done to try to kind of really break this logjam, sort of create innovation in this space, is this idea of blended capital. So our fund pools public capital with private capital. So we have investors like AXA who are ensuring our lives for the future, who are participating in this fund. We also have folks like the Green Climate Fund who are willing to put more concessional capital to play and underwrite a small amount of that risk. So it creates a catalytic effect. So for every dollar we've invested, we've brought back $10 into the market. That's been an extraordinary lift on the part of our team and on the part of our companies. But it's been really critical to really acknowledge that the businesses have products that are really serving real consumers on the ground and are driving to either addressing a carbon mitigation angle or an adaptation resilience angle. We can go into more detail about what that really means after this.
We can go to Amar's session for that. Just a couple more questions from me, and then we're going to go to our online audience for questions from them that they can put to the panelists. COP28 is coming up. What's needed? What would you like to see?
We are already seeing so much evolution in financial markets, private and public. Things like what you're referring to, impact-linked pricing, impact-linked carry, even the social, these things didn't exist 20 years ago. So there's already been so much innovation and evolution. I just want more of these innovations and evolutions to serve emerging and frontier markets better, be more integrative of what they see on the ground as far as the innovations that are needed and what local communities need on the ground.
Two very simple things. One, Article 6, sort out carbon markets and get them to work for people on the ground. Two, less rhetoric, less talk, more do. Let's just get this happening. I think everybody knows what's needed. We've all been banging on the door for enough of our lives. So let's make this happen.
I mean, I would totally echo those sentiments. More do, please. And I think probably I would add there is a tendency to want silver bullets. If we just get this initiative over the line, if we just sign this agreement, then we're golden. And actually, it's not a silver bullet. It is a series of fragments of silver bullets that might eventually lead to change. So I think moving away from the one thing and looking at the huge range of things
Brilliant.
That will get us where we need to go.
Final question from me. What would you like to see differently in 12 months' time?
Actually, it's the same thing that I'd like to see at COP.
Yeah. And you think that's achievable within 12 months?
I think based on what I've seen over the past few years, there will be upticks, there will be changes, as I already said, even with CFDA, which is just one of our programs that's addressing climate. 300 million has already been mobilized, but we're continuing to make these mechanisms more effective.
Brilliant. I like the optimism. Amar.
Sort of tied to what I've said, there's a real opportunity to have the framework for carbon markets to work for the poor and to drive real impact. And I think that can be done in 12 months if we just get off our proverbials to do it.
Yeah.
So that would be awesome. And I think there's half a dozen or so of really credible, maybe a dozen or so really credible intermediaries in market that are out there raising capital for their funds. I think I'd love to see those funds closed and capital being delivered to companies and out to customers.
Again, to echo, this is the perils of going last when questions like this are asked. I think I could probably encapsulate it in 2 words, which is more and faster. I don't think new things need to have something here that I don't need to mention, and that's perception.
Okay.
I really do think that sometimes there's a perception of there being more risk and difficulty in investing in this area than there actually is. And there's a huge amount of opportunity. And I come across a lot of organisations who have real ability to drive change, but there's too much of a risk appetite for potential investors, and the perception actually doesn't equate to the real risk.
To the reality. Brilliant. We've hopefully people who were joining us online have been able to put in their questions. Akansha, are you able to tell us what's been coming in?
So someone online has asked, how can we tackle some of the resistance from capital providers that Amar highlighted in his remarks? So Amar, it's kind of directed to you, but anyone can answer.
Can I jump in very quickly? I mean, I think it's the resistance is real. I think to your point, there is real resistance, and the track records of many investments aren't great. So we have to be more honest about what's possible and what we're seeing. I think there are some fundamental tailwinds, technology as well as regulatory. I think things like catalytic structures, things like public sector buying down some of the risk that will attract in some of the private capital, and then we have to show that there is a return to be made, right? So a big piece of this is that proof point of demonstrating with lower cost capital that there are profits to be made, there is capital that can be crowded in, and that there's a return to happen. But a lot of that is incumbent on us to demonstrate that. But with the instruments that we're all kind of talking about now on these sorts of forums, we see a real possibility of people looking at aggregation platforms, the types of organizations that we represent, that many others do, that are credible in market. In some ways, why not? Right, come on, why not? I turn the question around. What's stopping you? Because we're up for the debate, and we're up for the conversation of how do we design structure that addresses the kinds of concerns that folks have, and to, if possible, pop some of the bubbles of perceptual issues where it's just a perceived risk that's driving a risk of an aversion to allocating capital. So have the conversation, get engaged, come and talk to us.
Brilliant. Tara, you would add?
Yes, I have two pieces of research that I think the caller who's posed this question might enjoy or benefit from. One is from one of our programs, which is FCDO Mobilist program. You can find this on www.mobilistglobal.com. And this is on investor allocator appetites and strategies. So it unpacks some of why allocators don't do more. The other I just learned about recently, and I think our friends from Apex are in the room, they sponsored this, is by Create Research. It's also a survey of pensions regarding their appetites to ESG. And I know many others in the room can also share more about the appetites and the reasons why, some of which are founded. Some of those things we're not going to be able to surmount, whether it's political, but some of these catalytic capital instruments can surmount them. And I'll mention guarantees because it's quite top of mind. We're doing some research on that, which will be published shortly. And guarantees have mobilization rates that can go up to 5x. So we need more guarantees in the space, as well as many other mechanisms.
Extraordinarily powerful. Do we have other questions?
I've got another one. What ticket sizes are your blended finance vehicles putting into investments? One of the biggest gaps is to SMEs who can only effectively absorb, say, $500K to $1 million, not quite the 2, 5, 10 million that I see some facilities putting in today. How do you reach these businesses, and what pathways do you see that are viable?
Great question. I wonder if Tara, you might like to, and Sophia, if in any of the research we did, you came across that, but Tara.
So in the case of CFDA has what are called buy-ins, which are responding to specific challenges, which can be at a country or regional or even thematic level. And those buy-ins, yes, can potentially support investments into financial institutions or funds that will then back SMEs. There's not actually an SME fund that's a direct focus as it stands today, but totally agreed on the point, whether it's from within CFDA, whether it's even Chemonics more broadly, totally agreed that we all know SMEs are the lifeblood of economies, and the missing middle gap has been well documented, and a variety of donors and DFIs, some of which I think are in the room, are also aiming to tackle that missing middle gap through primarily GPs or debt funds.
Yeah, I mean, I think that's incredibly accurate. And there are a whole host of, sorry, wrong way again, my apologies. Yeah, I think it's what I think is a recurring theme on this panel is that there are these issues. Ticket size is an issue, country risk is an issue, currency risk is an issue. There are also a lot of examples in silos of where these issues have been overcome. And I think that's, if I can leave this room with one message, is, as Tara said, there are certain things that are insurmountable that you just cannot control. But for most other issues, there are ways and there are mechanisms, and Tara has just highlighted a few. So that would be my response to that question.
Oh, one other point.
Yes, and then we'll go for more.
One other point, just highlighting those in the ecosystem, collaborative for frontier finance.
Yes.
If the caller is not already in touch with them, as far as, you know, industry and ecosystem building around SME finance, particularly in emerging and frontier markets, I would highly suggest that they look them up.
I
Brilliant.
would echo that
Thank you.
sentiment.
Thank you.
Got another question here. Do we need greater incentives at the policy level to convince institutional investors to do more in this area?
Great question. Amar, would you like to have first stab at that?
You know, I always struggle with the high level policy piece around this stuff, right? So I kind of, in some ways, my reaction to that question is yes, and always, right? The first thing I'd say is the $7 trillion last year that the IMF noted were being invested in fossil fuel subsidies. Shifting that at the policy level would be extraordinary. It doesn't even require putting any more subsidies into non-fossil fuels. It just requires governments around the world saving $7 trillion. So that would be great. I mean, maybe I stop there. Carry on.
I think, similar to Amar, my instinctive reaction is absolutely yes. I think probably what needs to be clarified is whose policy at what level, and that is a very important follow-up question. Strategic policy interventions can be totally transformative, but they do have to be well thought through and considered and in the right position.
Tara?
Yes, agreed on all fronts. So this can range from, you know, at a country level, looking at how government support, you know, sovereigns and pensions to increase their allocations to GPs. This can also include the global financial architecture, whether we're talking about, you know, Basel II or other standards that actually could maybe be slightly punitive sometimes towards emerging and frontier markets, depending on how you look at it. So there's various levers, but all of these policy levers need to be addressed because actually it can sometimes slow down or it can dramatically accelerate all of the impact investment activities we're discussing now.
I think we've got time for one final question.
We've actually got so many. I'm just scrolling through them really quickly. So yeah, there's been a lot of discussion about risk preventing investment in sustainability in EMs, either perceived risk of traditional investors or actual currency or political risks. Who is best positioned to handle this? Development actors, impact investors, catalytic capital managers, or traditional capital advisors?
Fantastic question, and I'm going to make it really tricky because you've all got about 30 seconds to answer it. So perhaps we go Tara, Amar, there, and then Louise. I'll be interested in your thoughts, and perhaps we can hand back over to you then. So Tara.
It's going to take all of those actors working in tandem to not just for unlocking the capital, not just for solving the climate, you know, reaching the SDGs. There's no way one side, the policy side or the capital side, is going to address this in a silo.
Let me edit the question as we go down because I don't want to hear yes. So who would you say, let's say it does need all of them, where would you particularly shine the spotlight?
No, exactly. I mean, I think, sorry, do you want to chip in where, I think what I'd say here is specifically targeting how do we lower the cost of capital, right? So looking at that specifically is how do we lower the cost of capital to those that need it the most? You know, we've built a financial system where for very logical reasons, capital is most expensive to those that can least afford it. So policy interventions, catalytic work that articulates that, makes it real and tries to underpin it, I think would be where I'd put my money. Yeah.
Okay.
So one of the things that we really spotlight in the guide is the importance of partnerships. So to Tara's point about, yes, everybody, but everybody ideally working in concert on the specific areas of expertise and pushing specific buttons that they can. But really, and this is why I think the Just Transition training is so helpful, is it provides quite a clear structure and ultimate goal that allows these various actors with very different languages and very different priorities in many cases to come together under a single framework.
Great answer. Thank you. Thank you, Louise.
I would say providing support structures to reduce some of those risks that are putting off investors because they can't bear those risks. So how do you support SMEs to ensure that they are actually more resilient and the implicit risk is lower for investors?
Brilliant. Thank you.
So over to me, right. So a huge thank you for everyone online, but this isn't it. We will be making brief bullet point notes from the breakout sessions and sharing those with everyone who is dialed in. So thank you so much for your participation. It's decision time for the people in the room, because you get to choose which conversation you want to be part of. I would just say that Chatham House rules apply, so we will make bullet points, but we won't. We will not ascribe any comments to any particular people. And this is really about nurturing the conversation, really trying to think of innovative solutions, which we will capture and try and ensure that we take forward in some ways or another. So we'll just give a few minutes for the various different breakout rooms to be set up. Kieran and I will be floating around, and then we'll feed back to those who weren't able to go to one of the sessions they wanted to because they wanted to go to all three. We'll be summarising the results of those, which we'll then share with the group when we regroup. Thank you.
Thank you.
That's right. Before we break out, we're just going to give us a blurb, a summary of what each breakout will be. So the CFDA breakout, which will be right here, that's for those who want to learn more about CFDA, but also a deep dive with investors, with potential co-investors to understand, collect market feedback. What's the hurdles? What's stopping you? And where can Catalytic Capital help you deploy more in emerging frontier markets towards climate?
Okay, and the session I'll be part of, so come and join in, is